In this video, for our Wiley Plus examples, we're going to look at two of them in this one. We're going to look at exercise 9-8 and exercise 9-9. The 9-8 isn't that complicated once you kind of figure out what they're looking for. That's what I found would be the most troublesome for this one for my classes. What's happening here, just to give you a quick 1-minute recap, is they had an old accountant who, when they bought these two items, the building and the warehouse, decided that the building had a useful life of 40 years and a salvage value of $39,500. But recently they got a new accountant who said those estimates weren't really accurate. We really should have been using 50 years and a salvage value quite a bit higher for the building. Same for the warehouse, just different numbers going different directions. So what I've done here so far is I've made our opening T accounts with the cost of the building, $825,700, and then how much depreciation we've already taken. And then over here to the side, I'm going to determine what the book value is. We just simply take the difference between the two, and that'll give me a nice figure for our calculations. So what happens when you have a change in estimation in useful life? You don't have to go back and restate anything like you would if you had a change from LIFO to FIFO. That's an actual accounting principle change. And for comparison reasons, you would have to go back at least up to 2 years and restate your income statement in 1 year for the balance sheet. When it's just an estimation change, you don't have to go back and restate anything or recalculate prior year information. All we need to do is go from here on out and go forward. We're now in the year 2014. So what that means is this building has already been depreciated 8 years if you add up all the years up through the end of 2013. What I need to do now is recalculate the building's depreciation for 2014 moving forward. So the easiest way to do this is you always start with your cost. That didn't change, of course. That's not going to change. No estimate there. And what we want to do also is basically take our book value. So just to spell that out here, remember we take our costs minus our accumulated depreciation. And we want to take that out because I don't want to depreciate the whole $825,700 again. I've already depreciated a piece of that, the $157,240 of it. So therefore, I'm going to remove that piece because, again, I don't want to redepreciate it. And then, just like what we do in straight line, because they do want us to use straight line method, is what it tells us here in the instructions. Remember, you take your cost, but in this case, we take our cost minus any prior accumulated depreciation, and then subtract out our new updated salvage value. So that would be $64,920. And then, as we do straight line, we always take, that's our numerator, and then we always divide it by our useful life. Well, in this case, it would be really easy to say, okay, it's 50 years, because that's what the new guy said. Well, that's true, but that's 50 years based on what it should have been back in 2006. So really, we've used quite a bit of that 50 years. We've actually used 8 of those years. So what I want to do is take what the new guy thinks it should be, and then subtract out those 8 years that's included right here in this 157 number, and I don't want to use those. So my actual depreciation then is not that hard to actually figure in this case. So on your calculator, you can pull up and you take the $825,700 minus the $157,240, subtracting out the $64,920. And then divide, I get a total of $603,540. Divide that over 42 the useful life of 42 years, and the building is actually going to have a depreciation of $14,370. You're going to do the same thing with the warehouse that I just did here. The only difference is the years and when you bought it. We're still in 2014, but we bought it 3 years later. So therefore, we're not going to necessarily use the 50 minus 8 here. But I'll leave that up to you to figure up. Okay, now exercise 9-9. This one's a little bit more, takes a little bit more work. And what I'm going to do is go through the first two of these with you. And as you'll see here, I have some T accounts set up for a machine and the accumulated depreciation part of the machine. Each one of these is a separate type of transaction that happened within this business in 2014. And so I'm going to restart my T accounts when I finish up with, say, January 1. I'm going to clear it off and then use the same T accounts for January 30 or June 30th instead of having additional ones over here. So what I want to do is I want to basically put down on my books exactly what is happening in this problem for January 1. Okay, I don't quite have all of it showing here, but that's okay. I can scroll over. It says I retired a piece of machine that was purchased back in 2004. That's going to be important. Back in 2004, I'm going to put that there, and we bought it at the beginning of 2004, so we would have depreciated the entire year that year. The machine costs, and I want to get this into my T accounts, $62,830. And it also tells me we have a useful life of 10 years with no salvage value. Okay, so what I want to do, before I can determine what my journal entry is, because remember, we're now in year 2014, and we are at January 1. Before I can figure out what my journal entry will be here for 2014, I want to go over here and I need to figure out what would my accumulated depreciation balance be for this machine now that I'm at the end of 2013, beginning of 2014. Well, the best way to do that is just to go back and let's calculate what our depreciation would have been in year 1. The very first year that I bought it in January. In December, I was going to depreciate it. Well, let's go to my straight line formula. It says we use straight line here in the instructions. So remember, you take the cost minus your salvage value, which in this case is nothing, so minus 0, and then divide it by the useful life, which was 10 years. If you do that calculation, it's real easy. You move the decimal. $6,283 for the year 2004. Now the beauty of straight line is you don't have to recalculate anything for the remaining years. If you don't change anything with your equipment, meaning a change in estimate or a change in value, meaning you had a capital expenditure, you added something big onto that machine, it's going to be the same amount every year. Well, instead of typing it out 10 different times, let's just do the multiplication. Because if it's in 2004 when I bought it and that was the first year, I've now used it 10 years. If you count out 2004 all the way up to the end of 2013, that's 10 years. So total for the end of 2013, my actual balance is the entire amount, $62,830. I've completely depreciated this machine. I had a useful life of 10 years, and after the 10th year, I actually got rid of it. It worked out perfect. It says in the problem here that I retired it, meaning I didn't get anything. So simply on this one, this was a real easy journal entry. What I got, if you ask the debit question, what did you get? Cash is 0, so I don't need to put it in there. Why did you get the cash? Well, it's because I got rid of my machine. It's no longer on my books. So I'm going to credit my machine and debit my accumulated depreciation. And then my debits actually match my credits. I didn't get anything from my machine, but also it wasn't worth anything on my books. Therefore, I have no gain or loss. This is the only journal entry I need for January 1 to get rid of my machine. Okay, now we're going to look at this with the next problem. On June 30th, this machine is now a computer. I purchased it back in 2011. And again, I purchased it at the beginning of the year in 2011. The computer cost $36,350 with a useful life of 5 years and no salvage value. The computer was later sold on this date of June 30th for $15,540. We'll come back to that in a minute. But if you remember back from this chapter's lectures, if we sell something midway through the year, we have to do a depreciation journal entry for the amount that I've used it. But before I even do that, what I want to do is get an update of where my accumulated depreciation is up through the end of 2013, where I last did my calculation. So let's figure out what year one depreciation would have been. So remember, with a straight line, you simply just take your cost of the asset minus your salvage value, which again was 0, makes it real easy, and divide it by your useful life of 5 years. If you do this calculation, I know you won't be able to see the calculator, but 36,350 divided by 5, that's 7,270 per year. Now that first year was an entire year since I bought it at the beginning of January in 2011. Now I've had it for 3 years. So all I've got to do, because now we're at the end of 2013, my balance, if I times this number by for the 3 years, 2011, 2013, 2012, and 2013, I can get what my up-to-date accumulated depreciation was at the end of last year, which is all the more I would have depreciated so far. Now what I need to do is do a entry for 2014. I need to show that I actually used my piece of equipment for a half of a year. And so if this was the amount of a full year, the 7,270, I want to cut that in half. And so I'm going to be depreciating 3635. Credit my accumulated depreciation for this computers for 3635. Put in the 3635 here as a 2014 entry and get one final now updated accumulated depreciation total. I now have depreciated $25,445. It tells me in the problem now, because I can now go down to part 2, I can do my second entry for June 30th. I can actually do the sale. The question tells me that I sold it for $15,540. So I asked the question, what did I get? I got cash of $15,540. And then I asked the credit question, how did I get it? Well, I got rid of my computer. So I need to credit the $36,350. I'm going to skip a line or two. And I also, whenever I get rid of an asset, a long-term asset, I also have to get rid of its accumulated depreciation part. So I need to come over here, and I'm going to, so I don't run into the other numbers, I'll put it right above here. I need to debit my accumulated depreciation total of $25,445. Now, my debits right now equal $40,985. My credits equal $36,000. They don't balance yet. So what that tells me is when I sell it for more than it's worth, so let's do that little calculation we talked about in class. What I brought in, cash brought in, was $15,540, less the book value of my asset. Remember, book value is your cost minus your accumulated depreciation total. So therefore, I brought in more than it was worth on my books. If I bring in more than it's worth, that means I got a gain. And gains are treated very similar to a revenue. Whereas revenues are always a credit, so are gains. Gains are always a credit here. So I'm going to credit my gain on disposal for the $46.35. And if I add up my credits, they now equal $40,985, and my debits now equal $40,985. You're going to do the same work for the December 31 entry as well, and so I will leave you to try that one on your own. The next video will cover the much more complicated example of problem 9-5A.